Hi, everybody. This is Jack McCullough. I am really excited today as my guest is Suzy Taherian. Suzy is a longtime member of the CFO Leadership Council and is on one of the steering committees. She's also the CFO of Wrightspeed, Inc. And interestingly, she's an author of a book, The 80/20 CFO, which we'll talk about later. But Suzy, welcome. Thanks for joining us.
Hello, Jack. Thanks for having me. Really excited about this.
Yeah, me too. So why don't you tell our audience a little bit about Wrightspeed first?
Sure. So Wrightspeed is a company that makes electric powertrains for trucks and buses. We were founded by Ian Wright, who was the founder of Tesla. He made that company for passenger vehicles. Then he founded Wrightspeed for commercial vehicles, heavy-duty Class 6, 7, 8 trucks and buses. So we're trying to solve the environmental problem by introducing electric vehicles in that space.
Well, I didn't know that it was founded by the founder of Tesla. That's probably a good little thing to have on your resume, I would think. So, well, good for him. So cool. Well, Suzy, I'd love to learn a little about your path to becoming a CFO. One thing, it used to be in the day we all sort of had a similar path, but now there's a lot of different ways to get to that position. I'd love to hear about your journey.
Yeah, so it's interesting. A little bit of an unusual path. I actually started as a mechanical engineer. So I studied engineering and then went back to business school, a couple of cold winters in Chicago, and got recruited by Chevron. And the great thing about Chevron is they have, like a lot of large companies, they have a leadership development program that gave me a chance to work through a lot of different areas in finance. So believe it or not, I wrote a 15-year plan when I joined Chevron about sort of what I thought were the roles and responsibilities that CFOs had, and how I would go about getting those experiences. And it was very fortunate for me that Chevron kind of helped me get those positions. So I had opportunities to do M&A and financing, but also work on internal controls and Sarbanes-Oxley and accounting and controller. I had included in there about having international assignments to get international experience, budgeting, forecasting. So I got a chance to sort of over the years collect all the different skill sets that I thought a CFO needed. And then from there, I ended up leaving Chevron and becoming CFO of very small VC-backed or private equity-backed companies. So it's a little unusual because sometimes people come to the CFO route from a CPA experience, or they come to it from an M&A banking background. So they don't have sort of the full gamut of experiences, but that opportunity Chevron gave me a chance to do all the above.
Yeah, it's interesting. You don't hear about a lot of CFOs who started out as engineers. And, my own path was pretty uninteresting compared to yours. I went to one of the big 8 in my day, and then accounting manager, controller, CFO. And, there are a million people who had a very similar path to the CFO job. Nothing wrong with it. Big 8 was a great training ground, but it sounds
Absolutely.
like experience at Chevron. So, and what was it like? So you went from Chevron, which is about as big as a company can get, to a startup community. That must have been an interesting transition.
Huge culture shock. It's a very different environment. There's the systems, the processes, the resources you're used to for a big company are not there. Had to buy all new clothes because the look and the attire is very different. And the pace is a lot faster. The startup I joined, we doubled in size in 1 year. We went from 100 people to 200 people. We did an IPO, stock price doubled. I mean, it's just a very, very frantic pace. When at Chevron, I would do a 15-year strategic plan, and we'd expect to grow somewhat at the pace of GDP growth. At a startup, we were doubling in size in a year, so you kind of threw out the playbook. A lot of fun, a lot of work, more opportunity to make an impact because it's a smaller place. But you're building a lot of infrastructure, and also just a lot more hands-on. You've got to wear a lot of different hats. There's not a separate insurance department or tax department or a budgeting and forecasting group to go to kind of do all of it. So very, big change to say the least.
It's interesting because there was a study, I'm going to say Chicago, but I'm not sure, but they said like the best big companies are the ones that emulate the practices of the entrepreneurial companies, and the startups that are most likely to sustain themselves in the long term, take on the best practices of large companies. So there's definitely, a lot to be learned from both environments. So.
That's a great saying. I like that. Yeah, it's exactly right, because that's what you're trying to do as a startup, is try to put in the process that a big company does. And then big companies at some point when they become mature, if they want to survive, they got to innovate like an entrepreneur startup. Yep.
Yeah, interesting. So how long have you been at Wrightspeed?
About a year.
Yeah,
I joined last year, right after COVID.
Yeah, that's what I was thinking. You joined at an interesting time to take a new leadership position. But tell us a little about, some of the challenges that you've overcome. What was, the first year in a new job during a global pandemic like?
Yeah, lots of challenges probably our audience guy is feeling. It's hard to start a new job because it's hard to build a culture and connect with the team if you can't be there in person. Fortunately, Wrightspeed has a huge hangar. It's about 110,000 square feet where we do our manufacturing. So lots of space, so you can be social distancing. So even though I didn't have to come in person, I could do a lot of the work virtually. I'd come in just to be able to connect with the team. You have a lot of conversations over the coffee pot or the tea in my case. And so COVID made that difficult because if we didn't meet face to face, you miss a lot of the subtext. So I try to come in and sort of connect with people I could, or do a lot of more Zoom calls and calls. You don't have the chance to say, hey, let's go grab some lunch and just chat and talk through an issue. So trying to find other ways to do that. As a small company that was looking to grow, we were raising financing. And it was amazing to me that the financial markets actually worked pretty well, but everything was by Zoom and calls versus normally investment bankers would fly in and you'd meet in person or go on a roadshow in person. So doing all the financing activities virtually was more challenging because it takes longer to build relationships. And for them to come in and literally kick the tires and see the facility and see the product. But in some ways it made it faster, right? So we could have our investment banker could have 6 meetings for us in one day instead of, we have to fly around or drive around to them. But a lot of challenges. Yeah, it worked surprisingly well, but it was a clearly unusual year.
Yeah, I mean, give us credit, right? I mean, we'll certainly adapt quickly to any circumstance. We've proved that in the last year. Mm-hmm. But, it's not like there was a blueprint. I mean, the closest thing to what you as a business leader went through was, probably the Spanish flu of 1918. It's not like you could call on the CFOs from 1918 for advice on what they did. Most of them have, perhaps passed on since 140 at this point. So.
Yeah, I think that's a great point. I think part of the challenge was kind of having to make new policies. I mean, all of us were trying to figure out, do we do COVID testing? If we have symptoms in one employee, what we can and can't do. So yeah, as leaders, kind of very quickly making up policies and new strategies and pivoting. It really challenges the leaders for sure.
Yeah, it's probably the greatest challenge we will face during the course of our careers. So, but I wanted to chat with you also, and I actually took notes on this, but right at the start of the pandemic, right as we were sort of closing business, you are a contributor for Forbes, and you made a series of predictions on what to expect. So I'll put you on the spot a little bit. Do you mind if we kind of walk through those a little?
Yeah, Jack, I made predictions and I put them in writing and published them. What was I thinking?
Yeah, I made all sorts of predictions, but I kept them to myself. So, no, you actually, I don't know if you've even read your own article recently, but you did surprisingly well. So we'll walk through some of them, and some of them you were spot on. But the first one, you thought supply chains would be more local, a trust factor, less global. You're certainly closer to that sort of thing than I am. That feels like it largely has come true, yes?
That one definitely seems like it came true. And if you remember, it's hard to remember a year ago, but we were trying to scramble and find toilet paper on the supermarket shelves. And that was also happening in corporate world, right? We were all scrambling for supply chain to get parts and material from overseas. And because of all the impact on supply chains and shipments were delayed, much more expensive. And that did turn out as we thought. We're seeing a lot of companies trying to build facilities locally. You're seeing it definitely in the semiconductor chip industry now, with a lot of companies looking to put in semiconductor manufacturing facilities in U.S. for U.S. market or closer to U.S. market. And parts of it is also reducing the dependence on China. So part of it is global supply chains in generally, but also I think there was a realization that a lot of supply chains depend heavily on China. And there's definitely political at my highest level relationship issues that impact supply chains. So yeah, that one did come true. And we're seeing that still reverberates through the various economies and impact manufacturing, supply chain strategies, access to markets, et cetera.
Oh yeah, it definitely a game changer. Cool. So your second one, you absolutely crushed it. It was sort of a two-part. We'll be shopping, working, and playing online more, not just during the pandemic, but it'll be a bit of a permanent change. And you, the second part of that, commercial real estate would, sort of have its challenges and sort of repositioning itself. So fair to say you nailed that one, Suzy?
It definitely happened. Yeah, I think a lot of us lived on Zoom for the last year and a half. And you saw it in the stock price of Netflix. You saw it in the stock price of Zoom. A lot of us didn't wear shoes for a year because we were on Zoom and didn't have to drive through the office. You saw it in impact on driving and yeah. So that one absolutely came true. So I did good on that one.
Okay, yeah, you definitely did. And then you mentioned, and I hope you're wrong, but I suspect you aren't. You thought that the digital divide would become a chasm. And you were referencing, those of us who, have access to technology would probably be okay, but maybe some other people would struggle a little bit. Are you saying, is that kind of coming true? And I kind of hope not.
Yeah, unfortunately, I think that one is happening. And we see it both in companies that were more digitally connected, as well as people that were more digitally connected, benefited from the economy and actually did better as far as jobs and opportunities, as far as revenues and profits. That definitely seemed to benefit folks that were a bit more digitally connected. Now, I think the good news is maybe other folks also saw this trend. So I'm seeing initiatives to try to bridge that. Public schools are trying to provide laptops or iPads or access for folks. So there's some effort to bridge that digital divide. But yeah, I think that's going to be continuing to be a trend.
Yeah, I would think, and I won't speak for other countries because they've got that challenge. I would just think that's an imperative in the United States,
Mm-hmm.
right? Everybody should have, it's like not having access to electricity or running water. It's just how we live now. You need to have access to the internet. Hopefully we can get that.
Well, the simple fact is, like, if you want to get a COVID shot, you have to go online to register for the COVID shot. So not having online access, it becomes an absolute necessity. Just like you said, you need access to water and electricity. You need access to digital communication. Yep.
Yeah, I hadn't thought of that, but you're right. When I got my COVID shot, I had an appointment scheduled, in Massachusetts, in my age bracket. It was like on Sunday or, Monday, I became old enough to of the age to get mine. So I got up early that Monday morning. I scheduled something for I was up at 4:00. I scheduled something 3 miles from my house for the next day. It was easy, but yeah, if you didn't have that, gosh, what do you have to do? Physically drive there and then explain it? So yeah, it's an interesting one. Another one you suggested is there would be a bit of a home team bias. And the context was investing. People would invest close to home, maybe invest less globally. Are you seeing that one coming true?
Not as much. Some, though. I work with, I advise several different private equity firms, and I'm on the board of a SPAC, and we look at acquisitions. And when I talk to investors, I saw some great opportunities that came up for companies that were multinational, had some presence in the U.S., but also in Korea or Japan or China or Middle East. And what I hear from the private equity guys or investors sounds like an interesting opportunity, but it's going to be really hard for us to do due diligence in the COVID world. So they would shift to focus more on more local opportunities. And even a little bit at the beginning of the COVID, it was actually even more narrower. They would look at opportunities where they could drive and visit the facility. Now I think it's more national. So people in California may invest in a company in New York and vice versa. But it definitely makes the due diligence piece more difficult. So I think we're seeing that.
Interesting. Yeah, well, it'll be interesting to see if that's a trend that continues or if it's temporary. So another one, that universal healthcare would be less controversial. It would be, just about everybody would be behind it. And, I wonder what it says about us that universal healthcare would be controversial in some circles. But the fact is, it is controversial to some people. So,
yeah, I don't think I was right on that one, Jack. I don't know what grade you give me on that one. We did see, for example, that the vaccine is free and available to everyone. And there didn't seem to be any pushback or controversy on that. And you're seeing this trend and discussion about maybe removing the patent restrictions on the vaccine so that more generic brands could become available. But it still seems a somewhat touchy subject. So I think certainly in the context of providing healthcare for COVID, it seemed to come true. But there's still a long road ahead on that one.
Okay, interesting. And then you mentioned there would be unemployment benefits would no longer be perceived as, a bit of a character flaw. I think in your article you cited, it was like 3% unemployment. And, people who were unemployed, sometimes people thought, they were lazy or not trying hard enough. Has that changed a little bit to you?
I think there was a moment in time, especially if you remember briefly, unemployment in U.S. hit 15%, which is very, very high for us. And during that period, I think there was support for unemployment benefit, and there was extension of unemployment benefits and in fact, federal checks on top of it. I think now that we've come beyond that peak crisis mode and unemployment has come down again, we revert back to the more traditional view of it. At least that's what I'm seeing.
It's interesting. A friend of mine, I've actually known him just about my whole life. That goes way back. I've known him since the 1960s. And he has a carpet installation business right now. And, it's a hard, laborious process to install carpet in people's house. And he was kind of put out of business because it's a low margin business and he can't pay his workers as much as they can get from not working. So, to him, and, I'm sure he's not the only one, but well-intentioned, but he was like, geez, I wish we could be a little bit less generous because, if you have the option of making X and doing nothing or making, X minus $100 and working, doing a very physically demanding job, there's a good chance you're going to choose the former, right? Unless you just love your work or something like that. So, but what are we going to do, right? We need to take care of people now more than ever, I think. So, but cool. You mentioned also loss of trust, and you cited examples of people ever going to take cruises. Are you even going to be comfortable letting friends visit you? What do you think? That's more of a cultural thing than a business thing, perhaps. But what are you seeing and hearing? Is that part of the future?
It was definitely part of the past. So we saw, for example, we did our audit completely virtually this year. Like I said, with investment bankers, we did not invite anyone to our facility, and most of them didn't want to come even if we had invited them. Of course, cruise ship travel fell off. Airplane travel fell off like 90% at one point. It was a complete cliff, right? But it's coming back. In fact, a couple of weeks ago, I saw articles in the New York Times that suggested that people are booking cruises. Concerts in Europe in the fall are selling out. People are looking to travel over the summer. So it looks like the loss of trust definitely happened. It's coming back. It was interesting at the CFO forum, we did a CFO Leadership Council, we actually did a survey, and you asked our group if they would like to meet in person, and about half said yes, and half said, let's wait a little bit more. So I think for some people, they still are uncomfortable, but a good half are back and at it. So it surprised me that in some sectors, it came back more quickly than I expected. And in some sectors, or maybe sector is not the right word, for some part of the population, they're still very hesitant to get together. But we'll see. It was interesting in the fashion industry, for example, they talked about they're seeing a peacocking trend. For a long time, we were going online buying sweatpants and T-shirts because we were just going to be home. Now people are buying attractive dresses, high heel shoes for ladies, clothes that you clearly wear to go out and about. So they're seeing sort of that leading indicator that there's a lot of pent-up demand to go out and socialize.
Yeah, it's interesting. Yeah, my wife, she gets her vaccine Saturday, and then 2 weeks we'll all be home free. My kids and I are all set, and we're already talking like we kind of didn't really take a vacation last year. So we're thinking, geez, can I take the entire month of July off? Sort of do 2 weeks of vacation, 2 years of vacation in 1 year. And I don't think I'm alone. I think a lot of people are going to be doing that sort of stuff. And you're right. I'm not super old school, but I sort of am looking forward to the day that I can dress a little bit better. Although I did one of these, not my own, but I was on another webinar and the guy was dressed in like a Johnny Cash concert T-shirt. Thanks for dressing up for me, buddy. But he That's just the way he's going to be, I think. So, and the last prediction you made, risk management insurance takes center stage. Tell us a little about what you're thinking there.
That did have happened last year for sure, as we saw a lot of focus on people were concerned about obviously COVID risk, but a heightened awareness of other risk, a lot of employment risk. If you don't protect your employees properly, you could get sued. If you try to be too involved in dictating the terms of what the employees should or shouldn't do, you could get sued for being intrusive and not respecting their privacy, et cetera. So that was definitely a case. What I didn't foresee that really hit the insurance industry very hard is the huge activity in the SPAC market. These are the special purpose acquisition companies that just took off like wildfire last year and have really taken over IPOs as the more popular way to go public for companies. SPACs are different, and we can talk about them a little bit more, but that created a lot more public companies, but also there are different tools, and they move faster than an IPO. So the insurance market really was impacted. One, because there's more public companies. Two, because the process is faster, so maybe some of the risks are not being looked at as closely. And the share price of these companies that went public through the SPAC process were quite volatile, and so that obviously creates shareholder reaction. So, for example, you see in the D&O market, a huge impact there. So definitely insurance became a very hot topic for some of the reasons I first saw, but also for reasons that I hadn't predicted.
Yeah, I'm not sure if a year and a half ago, if I knew what a SPAC was. I think I would have guessed special purpose, perhaps. If you gave me something to think about. Had you heard of a SPAC? I mean, were these more common than I even realized that they were, like before?
They were not very common. I had heard of one. I had been for a while CFO of a company that had gone public through a SPAC process on the Canadian exchange many years ago. So they were done in Canada, but I wouldn't say they were very common. And a handful of people have heard of them. But the SPAC activity has been tremendous. There were more SPACs done last year than the last 10 years combined. So it's a huge increase in SPAC activity. And then you saw this SEC has been reacting to that with some concerns and trying to slow them down and put more rigor into them and put more restrictions and more scrutiny on it to try to strengthen the due diligence process there. But yeah, I think most of us were thinking, not sure what a SPAC is a year ago to how do I get in on this train? And a lot of SPACs are now doing SPAC 2, SPAC 3, because they can be a very attractive tool. So it's become a really popular, if you will, product in the Wall Street world.
Yeah, it's interesting. You know, it's sometimes worrisome. Is it like too easy to go public, right? I mean, I was scarred by the .com era, you know, and just about anybody could go public. And you know, if you had an interesting technology, that was kind of enough to go public. And you know, clearly that was a mistake. And you just wonder. Some people don't like regulation, but sometimes it actually does serve a positive role and protects us from ourselves a little bit. So, you made some predictions, and I do give you credit for putting them publicly on Forbes and talking about it. I'm going to give you a B+, maybe an A-.
Thank you. That's good grading.
Yeah, I'd give you an A+ had you thought to mention SPACs, but you're the one that reminded me that you forgot them. So
yeah, no, fair enough.
I know you always do have, since I've known you the last few years, you've always been very forward-looking, more than a lot of people that I know. Any trends you see for CFOs going forward in the business community generally?
I do. So I would suggest 3 trends that I'm very aware of that I think will play a big role for CFOs and folks in finance. The first one is more strategy. There was a survey done by Grant Thornton in 2020 that said 42% of CFOs spend about half their time on what they call the strategist role. So more strategy for CFOs. And this is the premise of the book that we wrote called 80/20 CFO, Making a Strategic Transformation in Your Company, is we realize that CFOs now more than ever are seen as a chief strategy officer and asked to be forward-looking rather than backward-looking. So it's great that we closed the books and paid the bills, And we're sure we did this with integrity. But now, what do we suggest to move the company forward? What's our view on M&A strategy? What's our view on allocation of resources and a very different kind of role for CFOs? The other interesting fact, corollary to that, is 29% of CEOs that were hired post-pandemic were formerly CFOs. So you're seeing this additional strategy role from CFOs is translating to the fact that boards of directors are saying, hey, now that strategic CFO is actually a really good CEO for me. So that trend, I think, will continue. I get called about once a month from a different company or recruiter that tells me there's a company that's looking for a CFO. They've got a really good guy or gal. She's a great chief accounting officer, but we need someone who's more strategic. So that, I think, would be a key one for finance folks. That's one.
That's fantastic. I was going to say, like, I haven't been a CFO since 2007, and no knock on myself or anyone, but the CFOs in 2007 could not have handled the events of the past year quite as well as CFOs today, and maybe we wouldn't have been asked to. But when I talk to companies, I see them on the forefront of the pivot and rethinking the strategy. The role they're playing is invaluable, and the backward-looking CFO, and I'm not knocking them, that's just how the game was back then. They would have struggled to make the differences. But anyway, I interrupted you. I apologize.
Absolutely agree. Yeah, the world has changed for the CFOs, and so that was a point we wrote the books to make them appreciate that this additional role they can play. The second trend that I think is really interesting to look at is more risk. It's interesting. This past month, David Swenson, who had been for many years running the Yale endowment, passed away, and it triggered a lot of comments about how he changed the world of investment for endowments, not just at Yale, but it reverberated through the entire industry of endowments and other financial institutions. So I'll give you a couple of data points since we're finance folks. When he took it over, the endowment in 1985, it had 25% of its investments in what was called alternative investments. So most of the money of the endowment was invested in stocks, bonds, and cash. And then the endowment was $1 billion. Fast forward for today, now it's a $32 billion endowment, wow. And 75% of it is in alternative investments. And Dave had a phenomenal track record. He got about 10% return every year for the last 2 decades, which is pretty impressive. But what that did is it triggered everybody else to say, we should shift to also these alternative investments, namely things like investing in venture capitals, private equity firms, hedge funds, and the like. And what that did is really transform these sectors into giants, right? Today, private equity and hedge funds are a very big player investments. And the other thing that did is private equity hedge funds, they look to have significant yield to their investors. They're looking for 20 to 50% return per year. And I just looked up, for example, North American venture funds in 2012 had the top quartile had about 30% return. So when we're pushing for these kind of returns and in a very low yield environment, right? Interest rates are very low. So as investment firms look for opportunities to increase that yield, they're looking for more risk. So what that has done is overall increase the appetite for risk. And you've seen it in retail investors too, with Bitcoin, with Dogecoin, with meme stocks, what have you. So in general, investors have gotten heightened appetite for risk but also demanding more returns. And that's pushing companies to take riskier positions, grow more rapidly, take on more leverage and debt, maybe expand in additional emerging countries to bring in additional revenue and growth, and so on. So as CFOs, we have to be aware that it's a world where we are pursuing more risk, and how as CFOs we protect the companies and also make sure that we are getting returns that are consistent with that additional risk we're taking. So I think it makes it much more interesting, more robust, but it is definitely a new world.
So that's fantastic. And sorry for me smirking. I don't know if you know, a fly landed on my head while you were talking of all the moments, right? But that's fascinating. Now, I had actually never heard of him until he died, but he's like a real visionary in the industry. And it's interesting because it's not only, colleges that are doing this, but like a lot of unions. They collect their union dues and they invest it. And I've heard the California Teachers Union is one of the biggest investors in the country. You can think about it, it's huge, right?
Yeah, exactly. Huge.
Yeah. They have a lot of influence in the investment community because of their share size. So, but it's fascinating. Cool. What other things are you sort of seeing in terms of your crystal ball, if you will?
The third big trend is ESG, more ESG.
If I may interrupt, just in case there's a few people who aren't sure what ESG is.
Yeah, sorry. It's environmental, social, and governance trends.
Okay.
And this is the trend towards investments in companies that are more environmentally responsible, that have a product or service that improves or solves climate change, companies that are very focused on diversity and inclusion metrics, that have strong governance. So ESG was there was always something called impact investing, and now it's really shifted to mainstream. So if you think about the world's largest sovereign wealth fund is actually the Norwegian sovereign wealth fund, which ironically made most of its money from selling oil. Norway is a big oil producer, but they take that money and invest it in the sovereign wealth fund. And they came out about a year or so ago, 2 years ago, I think, and said that they will no longer invest in fossil fuel companies. So and they've got about $1.3 trillion in assets under management. So the world's largest sovereign wealth fund saying, we are looking for companies with ESG metrics. Same time, BlackRock, which is also the world's largest asset management firm, I think they have $9 trillion under asset. So they also came out and said, these are giant companies, right? Looking up the numbers, yep, about 9 trillion. And they also came out and said, we're valuing environmental companies. We want to see good sustainability reports, et cetera, et cetera. Also a guy from Goldman Sachs. Goldman Sachs has said, we won't take a company public unless it's got a diverse board. So you're seeing not just from sort of nonprofits or NGOs, but huge financial investors that drive financial markets, European Central Bank. You're seeing the European government announcing last year that they will put $1 trillion into what they call the Green Deal. And they want to take Europe to be carbon free by 2050, I believe. And then the World Economic Forum jumped in and they partnered with the big four accounting firms. And this is why it's important for CFOs. The big four accounting firms came out last year and said they're going to put together what they think are the right sustainability metrics to be reported. So just like we report revenue and margins under GAAP, all companies would be required to report their sustainability and ESG metrics according to the big four structure. And that would become a mandatory requirement. So it goes from something that companies like to do. I think something like 10% of the companies used to have a sustainability report. Now about 80% of public companies have a sustainability report. And now it's going to become a mandatory sort of standard procedure under GAAP. So this ESG trend is continuing. It's going to benefit companies that are in the ESG sector. It's going to change the reporting requirements for CFOs. It's going to, there's a lot of tailwinds coming from the current administration to fund additional infrastructure. So it's just a huge trend. A lot of opportunities, a lot of jobs in there. And of course, hopefully significant impact and improvement in the environment and the planet. So that's a good thing.
Wow. Well, I for one am certainly hoping that prediction comes through. So that's fantastic. So Suzy, this was wonderful. Thanks for your time and your insights. I have, well, two other questions, but first, your book, The 80/20 CFO, and there aren't a lot of CFOs who've written books, and I'm just curious, what motivated you to write the book?
I partnered with a wonderful lady. Jan Berthold is my co-author. She is a head of an insurance broker firm called Heffernan Insurance, and she has authored another book on her own. But she approached me. She said she works with a lot of CFOs, new CFOs, who there's not a real good guidebook on how to be a new CFO. I mean, we get the accounting and finance stuff, but how to be a CFO, how to navigate a new company, and what's the key stakeholders, and what's important, and what do you do in the first 30, 60, 90 days. So it was her suggestion. She said, let's write a book, and then we can share this with new CFOs and be kind of a guidance for them. So she came up with the questions that she thought CFOs would ask, new CFOs would ask, and we wrote the book. And it seems like it's been helpful to some folks. So
yeah, I read it. I mean, it's the best CFO book I've read. And by the way, I wrote one. You, so acknowledging yours is better than mine, but they're both good reads. But I actually know Jen too. She like knows every single person in the Silicon Valley, I'm pretty sure.
She's
So
a wonderful person. She's
yeah.
great. She's great.
I definitely agree. So, Suzy, one thing I'd like to do with this series is we're trying to change the perception of CFOs and financial people generally. So, my first guest, he had a guitar behind him, and I challenged him to either play a song or tell a joke or show some artistic talent. And I'm wondering, do you have a joke that you can share with our audience? Leave them laughing, as they say.
Got it. I have no talents. I cannot play the guitar or sing, but I will tell you one joke that I like. And I like it because it kind of gets to the point of executive decision making and problem solving, if you will.
Always, you're always doing that. Turn the joke into the greater lesson.
And I'll let you draw your lessons. And I've seen parallels in some boards in leadership teams I've been in. So there's a small town in a mountain road, and they've got this pothole that's right at the curve of the road. And they had a problem with these cars coming in, following the pothole and losing control and going off the cliff and having fatalities. So the town council gets together and said, how do we solve this problem? We've got this pothole and they keep having these car accidents, and the nearest hospital is 30 minutes away. And by the time we get there, these poor people perish. So one guy says, oh, I know what we do. We just park an ambulance right next to that pothole. Anytime someone gets in an accident, the ambulance can rush them to the hospital and, save their life. And someone says, oh my God, you're an idiot. That'd be so expensive and time consuming. No, what we need to do is build the hospital right next to the pothole. Then if they have an accident, they just, we just drag them across the street to the hospital and problem is solved. And the third guy goes, I can't believe it. You guys are building a hospital, building an ambulance. These are complicated, expensive solutions. Clearly what we need to do is fill in that pothole and then dig in a pothole right next to the hospital 30 minutes away. And that'll solve the problem. So I just suggest that next time you have a team meeting and the executives come up with solutions, see if you can get them to pick one of those three.
There you go. Yeah, that makes a lot of sense. Well, you reminded me, you probably know the true story of the astronaut pen.
I love that one. Yeah, tell it though. I love that one.
Okay. Well, you might tell it better than me, but when during the space race in the 60s, and it is a true story, right? I'm correct in saying that?
Yes.
So,
yes.
One of the challenges astronauts had to write upside down, and the ink didn't work. So they actually hired a team of engineers to develop a pen specifically so that astronauts could write upside down like that, which is their common position. The Russian, I believe the Russians call them cosmonauts. They had the same problem, but they solved it by using a pencil. And it shows you, right? You don't need to necessarily go high tech for every problem. So
yeah, I believe our pen was a $5 million solution, and their pencil was 50 cents. I love that one, and I mentioned that because I've worked for some technology companies, and when they come up with a great technology solution, I check to see if it's a $5 million pen or is it the pencil. I love it.
Yeah, there was a company. It was out your way. It was like a juicer or something. And it's, they were like getting orange from a juice more efficiently. And I was just like, is that hard? You're really solving a lot of people's problems. They actually raised a good amount of money, but then, people weren't buying the product. So anyway, Suzy, this was fantastic. All of my members are busy, but I know you in particular have a lot going on. So I appreciate you taking the time to join us today. And have a great rest of the day.
Always great talking with you, Jack. Thank you so much. Take care.
You too. Okay, that was good. Were you happy with that?
Oh, that was fun. Thank you, Jack. You always make it really enjoyable, and you make me sound smart. Thank you.
Hold on, I'm just going to end the broadcast now. And we may disappear.